How are you? Enzo DiCostanzo, clinical professor of economics and finance, St. Peter's University in Jersey City, New Jersey, coming to you from Newark as usual. This is the second part of the investments Excel presentation. Okay. Yeah, we stopped. What did we stop yesterday? An hour and 12 minutes or something like that. So this will be shorter. Okay, this will be short. But let's just dive right into it. Just pick up where we left off yesterday. Okay, folks, here we are. We stopped at value and reporting investments. I think is where we stopped at. Oops, pardon me for that loud clanging. We don't like it. Okay, so yeah, we're at 150, which is where we're, again, this is just me. I can check my answers as I go along here. So yeah, now look, when you have any insurance like real estate or even the value of an automobile or something like that, it can fluctuate dramatically over 12 months or something like that. And this is just an example here. Now, again, these guys are dating themselves a bit from the examples that they used. Time Warner was $58, high, low of $9. If you look at all the securities that are for sale, Apple, whatever it might be, they have, a 12-month max, 12-month min, daily high, daily low, and obviously, the more of a statistical analysis you do, you can find the highs and the lows during the day, during the week, during the month, during the year, 12 months, whatever it might be. A valuation could be a cost, it could be a fair value, or it could be the lower of cost or market value. So there's a couple sort of choices here. Many people argue that fair value offers the best approach because it represents the expected cash realizable value of a security. Is the amount for which a security could be sold in normal market. That's what fair value is. Others counter that unless the security is going to be sold soon, the fair value is not relevant because the price of the security will likely change again. So again, real estate prices, but certainly the price of shares of the Dow Jones, whatever, however many, I forget however many are in there, but all of those actually, just as we're talking here, let's plug into that. I forget what the number was. No, that's not what I wanted. Dow 30. I knew it was the Dow 30. Yeah. So yeah, what are the shares? 3M consists of the following shares. And what's the number? There's 30 large caps. Yeah. So again, the fluctuations in these: Cisco, Chevron, Caterpillar, Boeing, Apple, American Express, Goldman Sachs, ExxonMobil, Home Depot, United Health Group, Travelers, which is my insurance company, Walmart, of course, Walt Disney, okay, all that type of thing. Okay. And yeah, there's weighting. The weighting obviously add up to. We had figured this out when I was at NJIT, teaching at NJIT. I taught at NJIT very briefly and intermittently here and there. I remember it must have been like the early 2010s, like 2011 or 2012 or something like that. Where I remember in the summer went through the Dow Jones was computed, but I haven't done that in a while. But I remember that. I remember doing that. So yeah, so that's again, and these things fluctuate. So if you go to Yahoo Finance, you'll see how they move in the day and things of that nature. Okay, that's really what that is. Trading, available for sale, held to maturity. So again, you account for these things in different ways. Okay, you account for these things for sale in the near term, sometime in the future, holding, held to maturity. That's usually for debt. Okay, so there's a couple different classifications. Pardon me for yawning. Bit of a day today, that's for sure. So these are valuation guidelines. Okay. So let's see. I'm going to copy these, just drop them here because I already bolded these out. So when I make, again, the good thing about having my original here is when I make changes, we can alter that. We can alter these changes as we go along. So it gives the option to apply for fair value accounting rather than historical. So yeah, so this is, you guys probably don't remember this, but because it was in the news when most of you are probably just a couple years old. But Enron was a Houston, Texas, not a technology company, but an oil and gas sort of trading company, and they really just specialized in sort of the energy. I don't remember if it was called N1 Energy, but it was mostly trading in securities of in energy in the energy sector, and they own some power lines in California or some power companies in a couple different places. And I think what they did is they just used these assets as collateral to just borrow more money and all that other stuff. And that's all they were just uber leveraging based on assets and that they may or may not have owned, or the valuations moved around a bit and all that. So there was a lot of opaque, not so much opaqueness, but just a lot of cloudiness to sort of what was really going on. I had met some people who worked for Enron about 20 years ago, and they were their attitude was like, if the company said it, that's what it is. So that's ominous when people sort of answer questions like that. So I always hit F1 when I don't want to. So trading securities are short-term investments and increased likelihood they will be sold at fair value. Okay, like I said, so fair value is just something you need to keep in mind. This is the first one, sort of how we're going to sort of deal with a fair value valuations. And here I'm just going to pick these four numbers off like this, and boom, we'll just drop in here. So bonds, stock. So the cost and fair value for investments. Pace Corporation classified as trading some securities. So it's just whatever the company was. Pace Corp. Yeah, I'm sure Pace University, the pension fund or whatever it might be. We're looking at unrealized gains, and actually, they give you the answer, but we want to be able to compute it. So, if you bought some Yorkville Company bonds at $50,000, now their fair value is $48,000. Obviously, you lost $2,000, right? So you can take fair value minus what you paid for them. Okay, this other one, you're going to take fair value minus $90,000. Obviously, that's a gain, is what that is. You spent $140,000, right, to buy securities, and now they're worth $147,000. So you can do it one of two ways. You can net out either way. Either going across, fair value minus cost, or just add up the unrealized gains or loss. You have a loss and a gain, but you're netting out at a gain. Okay, so that's where the 7,000 comes in. So yeah, so look, here's cost, here's fair value. They record through an adjusting entry. Now, looking at this sort of, how this gain sort of happened, you're going to look at this and just say equal 7,000, and this is sort of how you're looking at sort of making your accounting entry for this. So market adjustment for trading, obviously assets increased by 7,000, and then gain is 7,000. So your equity account, it's credit, which is plus, and your asset account, it's debit, which is plus. The 7,000 is balance. Okay, that's why that looks how it looks. Market adjustment trading account enables pays to maintain record of investment cost. Okay, so like I said, you guys can sort of read through this as you go along. And when it's a trading security, you're recording your unrealized gain under other revenues and gains section, which I think we went back in time and I showed you something somewhere. What was it? Merchandising somewhere, inventories, systems. Where was it? I showed it somewhere the other day. It's not that. It's not partnerships. Is it under assets? No, it's not be under assets. Their income statement maybe. Yeah, here it is. So yeah, non-operating activities. Here's other gains, revenues and gains, expenses and losses. Okay. So it came from there. That's where you're gonna put this. Okay. That's your 7,000. Like the rest of this is just a little bit of a discussion. Next one is available for sale, and this is the company, whatever it is, Ingro or something, whatever it might be. And again, you're going to pull out your cost and your fair value. Okay. There's your cost, fair value, Fair value minus cost is right there. Fair value. And again, I think you have, yeah, gain. One's a gain and one's a loss. And you can do this a couple different ways. And here, we'll do it like this time. I'll take fair value minus cost. So you're looking at a loss of about 9,537, which is what that is. Okay. So there's two securities and how it classifies them and provides information on the cost, fair value, and the amount of the unrealized gain or loss. There's unrealized loss of 9,537 because the total is right. You spent 293,000 and now the fair value is 284. So it's about a $10,000 loss is what that is. And regardless of that, that's this is available for sale. That was about, and again, valuation, and this is trading securities valuation. Actually, this should have been all caps. And we're going to look at a loss here of 9,537. All right, realized loss on available for sale securities. Okay, so again, the loss on the equity side is debit, and on the asset side it's credit, and the two negatives balance. Okay, like I said, you guys can read the rest of that stuff on your own. This is an illustration which finishes this part of it. So this is going to be, this is both trading and available, and we have these all in the same part of things. And again, instead of me just typing these, I don't think what's to gain by just copying and pasting these. So we have trading securities that we spent $93,600 to buy, and then now the market value is $94,900, and available for sale. Again, those are also a little bit about almost 3,000 higher type thing. And here you can just do this since we've worked this out already. You can just come down here, boom, right? It's fair value minus cost, fair value minus cost there. And actually down here, we don't have these other two. And here, let's do them. Copy right there. Okay, so it's so yeah, so fair value minus cost, 3,900. Okay. And yeah, so this account had a debit balance of 9,200, and this is going to be gains, right? So you're going to add it to that. I hope. Should it be gains? Let's see what happens. So this is, yeah. So as a debit of that, right? You know, now we did loss here, but trading, yeah. If it's a debit balance though, and this is debit also, right? Shouldn't you add those? Right, I would think so. And this says market adjustment trading, however, sale has a credit. Prepare the journal entries for each group of securities. Okay. So, yeah, this is gain or loss. This is loss and available for sale. Well, they're both gains, right? These are both gains. Let's see. Is this one going to make sense? I hope. This is available for sale. So, had a credit of 57 something. And you added that. Now, it's saying, here's what it's saying here with this stuff. I'll tell you, maybe they meant here that because this makes sense. If your loss was 9,200, right, and you're talking about trading securities, you have a gain of 1,300. Now that makes sense, right? Because what happens is you have your loss here equals 9,200, and you made up 1,300. That makes sense, right? That's how you get 7,900. Okay, see how I did that? That's logical to me, because if it says here, if you have a debit of 92 and you're on the loss side, this maybe in here this might be maybe not so clear, but if you're on the loss side, that makes sense, because if you're losing and you're on the credit on the debit side and you subtract out 1,300, it's gain. It's less of a loss, so you're making up part of your loss. So 7,900 makes sense to this. Okay, this one. So this equals 5750. Yeah, this has got to be a plus, right? This has got to be 2,600. Right, yeah. Right. So if this is credit, so it's a gain, and you gained even more, right? You went from 5750 to another 26. So that's how you get to 8350. Okay. So yeah, so it's a little I think they meant here gains and losses, because this is just asset pieces to this. You just got to be careful. You got to know what's debit, what's credit, what's plus, what's minus, because it doesn't make any sense. Look at this. It says market adjustment trading has account. If it's a debit balance, right, and you have a gain right here, looking at this. So and this is the loss entry. So maybe they're just trying to make it a little more complicated, I suppose. So in terms of the losses, though, yeah, because that would be this side, right? And if you have a gain, you overwrite this loss a bit. So who knows? Maybe there could have been and something like this. If it's I mean, I'm trying to explain what the book has, but I have some questions, because if this is a game, why do we have a loss entry here, right? So if we're looking in the book, that's what the book has, right? There's loss here, gain or loss here, type of a thing. Right. So you got to be careful with this. Like I said, the more of these we do, I think that the clearer it's going to be. But the market adjustment and trading pieces. So yeah, this is the last one for that. Okay. But like I said, you got to. This is right for what this is. And like I said, so maybe just think of these as the gains and losses as opposed to the market adjustment accounts. But and again, if you're looking at a loss and you're trying to overwrite the loss statement, then this sort of makes sense like that. But like I said, there's a little complexity in that, and that's all well and good. This is the balance sheet presentation. And this is going to take a little bit of time. Yeah, so we're gonna fill this in and discuss all the different entries. So yeah, so this is the last sort of part of this. Then you have a comprehensive problem here, which it does a couple different things. Which I think we're gonna go over. I think we're gonna go over both, and then we'll see how much time we have for self-test questions. And there's only 13 of them. So like I said, I sort of instead of making another video tomorrow, let's just sort of maybe get everything taken care of today. Trading securities is short term, available for sale long term. Okay, so look at this. Classified as investments either short or long term, called marketable securities held by the company that are readily marketable, intended to be converted into cash for the next year operating cycle, whichever is longer. Both criteria are classified as long-term investments. Okay. Short-term paper, certificate of deposit, money market certificates, treasury bills, commercial paper. Okay, so there's a couple versions of this, and these are all businesses in the big, in the big commercial, the big financial services firms. Yeah, these are all businesses. Okay, there's a short-term paper. What that is. Yeah, if there's some sort of conversion happening either within the operating cycle or beyond the operating cycle, and that's something we can sort of deal with. Long-term investments are below current assets. Yeah, a lot of this just sort of discusses, how everything happens here. Non-operating items related to investments and the unrealized gains and losses and the income and loss on sale of investment and where all this stuff sort of goes. These are non-operating items related to investments. The gains can affect volatility. Trying to figure out what was sold at fair value or not. You'll see all those kinds of things happening. Now, the classified balance sheet, you have several parts to this. And again, you guys should give a good read to all of this stuff. You're trying to figure out which one of these are reported in the financial statements. Interest earned on the investment for bonds, gains, unrealized gains on trading securities, and those kinds of questions. And we have this. So, we have this worked out for us here. So I'll show you here. Let's get the other piece of this. I think it's already here, but so you have each of these items: market adjustment for sale, gain on sale of investment, unrealized loss, unrealized gain, interest earned. Okay. Interest earned is income statement, other revenues and gains. Market adjustment is balance sheet, investments, asset. Unrealized loss unavailable for sale, balance sheet, stockholders' equity. Gain, other revenues. Again, that's 3 and 4. Those are easy to sort of switch, where you're looking, stockholders' equity or other revenues and gains, trading securities on other revenues and gains. Okay, all that. So again, there was some this is a question in the book, I'm sure. How to express some of this, the financial statement presentation of investments, and yeah. So the drum roll finally. What we're looking at here. So again, looking through now. This again, I know we didn't read the whole book together, and I understand that. But I'm just going to go through this almost like we did. This is chapter 16. So this ties together everything for the first 16 chapters that we know about balance sheets. That's what this does for us. Okay. So you're going to have now in terms of entries. Obviously, I just had a big block of this, and we'll just clear this out. Cash is again, there was a whole chapter in cash that we really didn't go over with you guys, but there's 21,000 in cash. Short-term securities at fair value, right, is there. Accounts receivable, 1, 2, 3. All right, and this is doubtful accounts. Yeah, and looking at this, as we're doing this, we need to get rid of those extra. There's just no point to these extra zeros. So it's just taking up space. Inventory, and actually look at this. This equals this minus that. This is 43, 1, 2, 3. 23, 1, 2, 3. And this is just equal to the sum of all that, comma, these two. Is it 314,000? Should be, yeah, just 314,000. This is 50,000. Oops, wrong spot. Right, you're right there. So this is less than 20% of the owned companies at fair value. And yeah, this other one should be 20 to 50. I don't know why it's not. I don't know how that happened, but so maybe I figured this out. Yeah, that's going to be 20 to 50. So yeah, so sorry. Again, a little adjustment there as we went along. So total investments. We're always fixing things. 200,000. Land. This is 800. 1, 2, 3. I may have you do something like this for like maybe the last assignment for the course. There's depreciation, so you're going to learn how to do a lot of this. All right, how to manipulate this balance sheet. All right. This is equipment is 180. The value, the book value is 180. 54,000 depreciation. And this equals the sum of this, comma, 926,000. Goodwill. Funny enough, what goodwill is. See, investments, total plant, and then current assets. 1,710,000. Okay. Okay, so save this as you go. So there's your asset part of this. So again, almost every line of this was a chapter, this was a chapter. A lot of these were chapters. Some of these receivables was its own chapter. Inventory was its own chapter. Cash was its own chapter. Investments was its own chapter. Plant property equipment was its own. So a lot of these were their own. Certain current liabilities, a lot of those were their own chapter. Okay. This is payables, what you owe somebody else. All right. This is income taxes that you owe. I have a neighbor who tried to test this and lost. All right. There's interest payable. All right, $255,000. And this is the bond, and then subtract out the discount that it was. And again, this was another previous chapter that we dealt with, the discounts and the premiums. All right, you're subtracting these two. All right, which is there. And this is this. There's the total liability number. Okay, 554,000. And this is almost the most complicated part of this. This would be $10 par times 80,000 shares. That's 800,000. Paid in capital excess. So this is additional investment in the company. 100,000. So the total here is the total initial paid in capital is 900,000. Retained earnings 255. 1, 2, 3. This is this. All right, $1,155,000, and then unrealized gain in security 10,000. Okay, so this whole thing equals this plus this plus paid in capital. All right. What happened here? This is, you're adding this, that, and I think you need to add in retained earnings to, so what happened here with this? 800, 100, that's 900. Oh, I think we did paid in capital too many times. We did something too many times. Oops. Let's see. Yeah, so, okay, sorry about that. Here's extra. That's extra. There it is. All right, I had a subtotal added twice. $1,710,000. Okay. And it says there's some retained earnings, maybe a third of this for plant expansion. Okay, but there you go. And again, so maybe be prepared for a balance sheet like that. Maybe prepare for something like that. We have a comprehensive problem here, which is the next thing I want to work on. And then you have the self-test. So we're going to go through. You know what I want you to do? I want you to take a minute and just give me a sec to just sort of bounce up and down for a second. It's like a quick intermission, which I don't like to do these, but give me a minute on this. Give me a minute. Back. There we go. Sorry. Like Mike Francesca. We had like a little commercial break, I hope. I hope you had. Hopefully you read through these very quickly. Well, I took that second to just go do something. And DeMarco Company has some investments, stock investments and trading securities. Sandberg, 600 shares. 800 of Say. This was 200. And this was, so for Sandberg, there were some sales. So Sandberg was 600 minus the 200, gave you that 400. Okay. So there you go. And now we'll go through, how we did everything here. I just, we're going to need these for computational purposes. Just go one by one. First one, we purchased this, DeMarco purchased 600 shares of Sandberg at $24 a share and then $300 brokerage fee. Okay, so this is going to be equal to 600 times 24 a share plus 300. That's a part of it. That's a part of it. Okay. On the 1st of July, 800 shares, 33, 600. And this was just 27,000 to record the purchase of 800 shares. Okay, 27,000. We received a revenue from Say Corporation, and that we have 800 times $1. And then on the 1st of November, we sold. Well, Sandberg we bought here. And let's just to enter Sandberg. There's Sandberg and the two different places. So we sold a third of this. So this gets written to, and looking at this, so Sandberg 27. We bought a 24, selling 27. Okay, so a third we're selling. That's why there's 400 here. All right, that's why there's 400 there. So a third gets written down. So looking at this equals parenthesis 200 divided by 600 times the initial Sandberg investment was 14,700. All right, so that's 49. That's how this. That's the write down on that asset, and then you're selling 200 at 27. And then the difference is obviously the gain, 500. There you go, there's a $500 gain. You bought it at 49. So again, look at this. You have to include the fees. You got to include all that stuff. Okay. So here again, just going back and looking at these, how we did all this. This was 600 times 24 plus the $300 brokerage fee. That was just equal to that. This was 800 times 33 plus 600. Okay, and this was just dividends. This was just the 800 times $1, and this was the stock investment. Okay, and this is what we received. We sold it for, what was it, $27 a share. And then there's our difference. Now dividend, again, for what's left for Sandberg, this is equal to 0.50, right, times what? 50 cents Sandberg. What's left for Sandberg? Sandberg is 400 left, right? So that's 200. Okay, that's the cash dividend for Sandberg. And then for the part B on all this, we're going to look at a couple of these stocks here. So this was, yeah, you got to figure out what's left, what's fair value. And it says that, it says, somewhere it said it here. It said that Sandberg 25. So yeah, the fair value is now at the 31st. So Sandberg, let's just deal with Sandberg. Fair value is just simply 25. And then you want to figure out what's left. What's left in Sandberg is 400 shares, right? That's why that's $10,000, right, which is right there. Okay. What you bought it at, well, what you bought it at gets a little interesting. There's 400 left, okay, which is times 24, right? There's 400 left times 24, which is what you bought it for. And it's 400 over 600. Actually, what I should probably do here, this is the original 600, the original 400. All right. That's still at 98. Okay. So looking at this, so this is equal to, so again, in terms of what you bought this for, we're going to do, there's 400 left over the 600 times that initial entry, which is the 14. All right. All right, so what do we do here? This was, no, we did that, we did this. Yeah, this is 98. And obviously, look at this. This is equal to this minus that. Okay. Oh wait. So we're here. Yeah, this is one way to do it. What I just showed. I'm just trying to figure out how I did it previously. This was the ratio of what to what? 4 to 6. It's the brokerage fee. And then, yeah, this works too. It's a different way, but yeah. So what we did was we did 4/6 of the brokerage fee plus $24 times what was left in shares is what we did with this. And yeah, that makes sense because that 24 is times the 400, which is what's left. That's the remainder, right? BF20, yeah, BF20, yeah. And we use BF20 again here, is numerator over denominator. So it's the same thing. Yeah, that's why it's the same number. Okay. Like I said, this works too. This is just simply, what remains here, which I think is the better way. So it's 400 shares left, so just times the stock investment. Okay. The Say Corporation, what they say that the fair value was 30 times 800. There's a formula in there, and then the cost would be 27,000. That we just set it equal to what we had here. Okay. And you're just summing up your costs. And this is going to be, we could do it like this. Sum parentheses. So it's a $2,800 loss. So yeah, this is equal negative of that, and then this equals that. Okay. So yeah, include the price paid plus brokerage fees. Gain or loss is the difference between the net selling price and the cost of security. Basic adjustment of the fair value on total difference between the cost and the fair value. Yeah, we did all those. We knocked all three of those out. And again, you're going to have this. This is just equal to that. This is just equal to the negative of that. This is 30 times the shares that are left of SAKE, which is 800, right? Just 30 times those shares. This is just simply $25 times what's left of Sandberg. Okay, so yeah, these names, I don't know if you guys, how much of a baseball group you guys are, but Sandberg, there was a Ryan Sandberg that was in the played the second base for the Cubs, I think for the Phillies very, very early in his career. And Ron Say was a third baseman for the Dodgers. And these clubs played each other in like the mid '84. I think Ron Say was on was on Chicago, and Sandberg was on Chicago in like the mid '80s. So these are baseball guys. It's really what I catch that. The names. So these are all very sports oriented. Again, I'm an intellectual. They're an intellectual. So we all like to watch sports and things like that. Okay, but there you go. Okay, so we got through all the entries. We did the adjusting entries and made the valuations. Okay, so there's your comprehensive problem. You know what? We're just going to go for it. These are the self-test questions. Let's hit this. Let's go through these so you have everything. So you have this whole chapter basically up to the self-test questions. And like I said, I'm going to pick something. I might pick, where was it? Maybe this might be the last problem for the course, perhaps. 16.6a. This is create the balance sheet. I might have you do that. I might, write it up tonight for you guys. But that's 16.6a. And actually, you know what? I'm probably just going to pick off this, and I'll just dump it here. That would be assignment number 6. So, and actually, here, just as we're talking, I think I can just quickly do this. So, copy. Just give me a second. What we do? I do this in class sometimes. Just get something done very quickly. Some sort of bookkeeping thing I need to get done in class. All right, and this is going to be assignment number 6. Right here, rename. So you can watch me work a little bit too. Assignment number 6, which is right there. Okay, so these are here. And actually, what I'm going to do, here, I'm going to have you guys. I'm going to have you guys work these. So, okay, and then here, yeah. So this might be a good one to, I'll tell you, getting these types of things working, this is a big part of things. Getting stuff like this to work. There we go. Okay. So yeah. So there's assignment number. I'll type out the. You're going to have it in the template. Okay. So when we put the template up there, the assignment template for number 6 is going to be up there, and we'll get to that. Okay. But so yeah. Actually, let me. I don't know. If you guys bear with me for a minute here. What are we doing this thing? Where were we? We were here. Economics. See, I have a lot of folders, right, with all the stuff that we do. So this is assignment number 6. Okay, and this is due that last week, June 29. was when this is due. This is almost like your final exam. Any day up to Tuesday the 30th. That's balance sheet. Okay. And so let's see. And again, you're sort of seeing sort of how I, how I think things through. It says read the textbook. So we'll give you the textbook reference to this. This would be 750, PDF 750. This is balance sheet. All right. Oh, I don't want that. Radar Corporation. The tab, what it is, and this is the balance sheet model. Individual Excel file. Okay. Yeah, everything. These are all posted to Blackboard at this point. Okay, we'll get this up there for you guys. Yeah, there we go. So save. And again, just to show you guys, I have the PDF, the writer. I had to buy this, right? But it's great. It's really for what I do. You know, I'm a professional. I use this, across the board. But see, I hit the PDF create button or PDF maker, and we're making the PDF. It takes a couple minutes here. Okay, but I guess it's $100. But if you're going to work in the legal services, you're going to work in accounting, you need to have stuff like this. Okay, you need stuff like this. Okay, there's the template for that. So you guys have that. You have the template all set up. It's Radar Company. Okay, and like I said, this you got to click on all the tabs. We want to answer these questions. We definitely want to answer some questions here. And let's see if we can sort through that market adjustment entry a little bit also. That'd be good to sort of go over that. And actually, what I wanted to do just very quickly, if you guys can just bear with me while I do it. There's Blackboard. Here's this again. Just you also see sort of how I how I do things. This would be use Excel template. Use Excel template. This would use Excel? This is balance sheet model. Use Excel template. Assignment number 6. And actually, with this one, I'm going to edit this. I'm going to get at least this much of it up here. Yeah, there's the balance sheet email. Okay. We're going to submit this, and we'll give you a slot to content. We're going to do new item. Yeah, actually, what I need to do is I need to just grab one. I'm going to grab the last one here and just edit. Yeah. So you see what you do is then, yeah, you're consistent with everything. You know, everything's consistent then. See what I'm doing here? I'm just sort of reusing. There's balance sheet model. Okay, and we'll put the email up also. Okay, do 3 attempts, multiple attempts, 3 attempts, cancel, content, item. The sixth and probably the last one that we're going to be working on. We're here. And this is balance sheet model. Okay, we have that. Track views, whatever. Oh, yeah, I was doing content. We need to go to assignment. Pardon me about that. That's assignment. Yeah, sorry about that. Copy, paste 6. Okay. Okay. Due date 100. Multiple attempts. 3 attempts at this. I don't want to do any late stuff with you guys. Okay, so you have the attachment here. Yeah, so submit. Yeah, there it is, 6. Okay. So you have another. If we go to, and I don't think anyone's grades are going to show up. So just don't want to. Everybody's pretty similar. So don't worry about it. Yeah, 5. Yeah, there's a sign. Whoops. There it is, 6. Okay. Somebody did 4. So again, I apologize if anybody. Whoops. If anybody's. I don't want anyone's stuff to come out here. So sorry. I apologize if you guys saw some things there. But yeah, all these pieces there. 6, 5, 6. Okay. But there you go. All right, so you have all the pieces sitting there with this. So you're ready to go. Okay, you're ready to go with this. And I before we do announcements, all these other types of things, I'll upload the Excel file to this and the announcements. I'll do all that. You know, we'll do all that as we go along. Okay, so yeah, so you got all that. That was assignment number 6. So you guys are all set. Okay, the last thing we have to do is get through the self-test questions. We'll just quickly do that. And yeah, so, you know, I mean, look, it's the 7th of June. I might do some cash flow video just sort of for your knowledge, but I think you have enough to do for the month of June. The balance sheet is a big, you know, piece of things, but you'll get more lectures. You're definitely going to get more. But in terms of the assignments, I think we're pretty much there. So. Why corporations invest in debt and equity securities, which is not the primary reason. Yeah, I mean, look, if government starts saying, hey, you know, ExxonMobil or Disney do X, Y, and Z, you know, you turn to, I hate to say it, but the Venezuela model, the Cuba model, or the government, you know, or the government control model, which isn't very effective. So it says which of the following is not, and you got to, you know, be careful with how you see what you see here. Okay, you got to be careful with what you see here. Okay, debt and equity securities. So right there, required. That's not a reason that they're required to. New line of business, excess cash, gain control of a competitor. Those are all reasons to buy financial instruments. Okay. Initial investments are initially recorded a cost, right? That's like anything else, like any kind of asset. No big surprise there. Haynes Company sells debt costing 26 for 28 plus accrued interest have been recorded and journalized the sale. So you're looking to journalize the sale. So looking at this, you're going to where the credits are. So if you're selling this, you're going to credit debt investment. It's a gain, so that's a credit. And the receivable is, well, yeah, if you're selling it, all right, it's the rare time that you credit receivables. So yeah, so all three of these get credited, is what that is. Okay, it's not just stock investments and bond interest receivable. It's not just the other two. It's not a loss because you're selling it at 28, so you know it's not going to be A. There's no correct answer. It's not that one. So like I said, so again, I'm seeing it in my mind, right? You sell a debt investment, you're going to credit debt investments. You're going to, if it's a gain, you're going to credit the gain, and then you're writing off the receivable because if it's accrued, but you sold the instrument, the other guy's the beneficiary, not you. So you're going to write that off. For 4, prior company receives net proceeds 42, and sell the stock, the cost 39. So how do you where do you deal with that? And you have operating revenue, operating expenses. So the proceeds are 42, so you're looking at a gain. So it's going to be something where it's not going to be A or B, it's going to be C or D. And the question is it operating revenues or other revenues and gains? This one's going to be C. Okay. So look at this. So you sold it for 2,500 more, okay, and it's not operating, right? It's an instrument, so it's other revenues and gains. It's not operating expense, not operating revenue, some of that stuff. Okay. Number 5, equity method is used for between 20 and 50% of investees' common stock. Okay. 6 and 7 is a combined one here a little bit. It says Horicon, 25% of the common shares of Sheboygan for 300,000. They reported net income 160, dividends 60. So yes, there's a couple things going on here. So if Horicon bought 25% of Sheboygan, they're in the 20 to 50%. So you got to use the equity method. So yeah, it says right here, equity method. Okay. So looking at what happens here, you're looking to report what? How are you going to recognize this particular investment? So it's going to be, you bought it for 300,000. Dividends were paid, so that just reclassifies for you because you're going to get 25% of the dividends, but you're subtracting that out from the investment account. So you're going to get 25% of the income. You're going to lose 25% of the dividends from the investment account, but you gain it obviously in another account. That's a loss there, but you just reclassify the dividend into another asset account, another equity account. Okay, so that's how it's 325 is really what that is. So it's just this. Okay, 300,000 is 25%, 160 minus the 60,000. It's right here. I have it right there for you guys. Okay, it's that one. And 7 is linked to this. It says use the information. Yeah. Now here's where the dividend goes. You debit cash and then you credit the stock investment, which is what we just said here. Okay, that's the other account. I said it was the asset account. It's the cash account. It's the asset. It's still asset. Okay. Controlling interest. You own more than 50% of the company. Which of the following statements is not true? Consolidated are useful to do what? Profitability. Yeah, well, of subsidiaries right away. So we have the wrong one first. Full extent of total obligations of enterprise. Yeah, true. Determine the breadth of parent operations. True. Profitability. Yeah, again, true. Okay, that's all true. So there you go. So the first, it's nothing to do with subsidiaries. Okay, so obviously the consolidated financial statements, that's the only one that's not true. 10, is at the end of the first year of operations, cost of trading securities 120, fair value is 115. So you're going to reduce the assets by 5,000, and there's going to be unrealized loss and other expenses and losses. Okay, so it's going to be that one. It's not going to be a real. It's an unrealized loss, not a realized loss, because you didn't sell anything. So it can't be A. It's not going to be the shareholders' equity, the stockholders' equity section is not going to be there. It's not going to be in other. It's not going to be in current assets. You're going to reduce that. It's going to be unrealized. Again, D's got a realized loss. C's got the unrealized loss. So C and D are almost identical, except this is unrealized. That's really what it is. Okay. 11, 12, and 13. Well, here let's sort of go backwards a bit. 13, short-term debt must be readily marketable to be sold within the next year operating cycle. Okay. Balance sheet, a debit balance to unrealized gain or loss is reported as what? Unrealized gain or loss is reported as a decrease in shareholders' equity. Yeah, so if you debit, you're decreasing that. And the drum roll for this last video on quite a Saturday, I got to tell you. This is available for sale. And what was this other one? This was, yeah, this was equity method. And this was available for sale. And probably that should have been bolded out. This goes through everything. You're going to do what? There was a credit balance there of 900. The fair value is 41. Again, we're thinking like it's a gain. Cost was 39. Subtract those, so 900 plus that gain, right? Because you're talking about gains is what you're talking about. Actually, what we could just do, copy, paste. And there you go. So for 11, right, available for sale 24. Yeah. Debit market adjustment at 20 because it's a gain, right? And credit unrealized gain or loss 2,400. That's how you do this. Okay. This hits me as being correct. Okay. So this is just simply, what are we doing here? This. There you go. That's it. Your gain and your asset adjustment. Okay. And this could always be, I keep changing these as we're going through all that. All right. All right, folks. So this is probably 2 hours or so. So let me actually just as we're talking here, let's just get this posted for you guys. So syllabus and schedule, Excel files, and again, give this a look. Right, all the different tabs. Here's the investment discussion, which is here. Everything is in here. So all the assignments, you guys are all ready to go. All the assignments, you have all the notes for the investment section. I don't think I'll be making any more videos tomorrow. Here's the sixth and I think the final assignment. Okay, the balance sheet. You guys get this and enter all these numbers. Yourselves. Organize what you're doing. Okay. So we'll shut this down. This particular one. And we'll just come to here. I do this in class often. I love this is what I love about Blackboard. I can just go boom, 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 and just update the Excel file in 15 seconds or whatever it might be. Okay. Okay, I'm not going to do the assignments or the announcements thing updated here because I gotta adjust that. But I'm just looking at this though. I don't see. So we did the second Excel here, and actually what I'm going to do with this is we just did it all in one piece here. This was this, okay, like that. Right, that was a comprehensive problem. And if we need another one, we have one sort of lingering down there for us. This we don't need, it's extra. So there'll be another link up here, and then I just got a couple, lingering around if they're needed. Okay, I'm gonna put the megabytes in. Okay, but yeah, no, we're good. So this is updated on the 7th, which is a Sunday. Let me save this. And folks, again, it was a pleasure spending some time with you, as always. There we go. Okay, folks, it was a pleasure spending some time. I know it's been a rough 3 months. Be strong. Don't, realize we're going to come out of this. And actually, I was debating whether to give you guys some economics stuff in class about the labor numbers. I'm leaning because there's a lot of time in the course left still. So I think you have enough to do finance-wise. We might spend. I'm going to do the cash flow notes and make a video. So next week you might not see some videos from me next week, just so you guys can sort of catch up. I'm getting some panicked emails from people about how they're feeling about the course. So let's give you guys a week to sort of catch up. This will be the last video for probably about 10 days, and then we'll give you more videos. Okay. So, all right, folks. It's always great spending time with you. Be well. Pray. Always be close to God. I always say that. Always be close to whoever your spiritual guidance is, Saint Gerard, Ignatius, whatever it might be, and know that we're going to pull through all this stuff. Okay. So everything's going to be fine, folks. We really will be okay. So talk to you soon.